You know, it is genuinely wild to think that right now, like literally as you are listening to this, there are millions of dollars swinging violently back and forth on financial markets,
Oh, absolutely.
and it is all entirely dependent on a single judge's gavel,
Yeah.
a gavel that is set to drop in Paris on July 7, 2026.
Right. It's not about votes yet. It's about a courtroom.
Exactly. We are looking at this crazy scenario where a single court date isn't just deciding someone's legal fate, it's actively driving a massive, highly leveraged financial market.
Yeah, it's basically a perfect storm. You have the raw, emotional volatility of politics colliding head-on with the cold, ruthless mechanics of leveraged trading.
And that is our mission for you today. Welcome to today's deep dive. We are jumping into a really fascinating piece of market analysis that dropped on June 20, 2026. It's titled 2027 French Election, Strategic Leverage and Market Analysis.
It's a great piece, really detailed.
It really is. So we're going to explore this bizarre high-stakes intersection where European politics meets prediction markets. We're unpacking how these traders process political uncertainty in a completely different universe than your traditional Gallup poll.
Yeah, the contrast between the two is staggering, honestly.
But look, before we get into the weeds of the margin calls and all the individual candidates, we need to set some ground rules, because this deep dive covers highly charged figures spanning both the left wing and the right wing of French politics.
Right, it gets heated very quickly.
Yeah, so we need to look at this strictly through the cold, impartial lens of a trader's spreadsheet. Our goal here is absolutely not to endorse any candidate, any ideology, or any specific viewpoint.
We aren't here to vote, basically.
Exactly. We are just here to do the math and analyze the data from the source material impartially.
Well, what's fascinating here is that prediction markets platforms like Polymarket, they don't just ask the simple question of who will win the election.
Right, because that's what a normal poll does.
Exactly. A traditional poll takes a snapshot of public sentiment today. Prediction markets ask a much more complex, dynamic question. They ask, when will the probabilities shift?
When will the odds actually move?
Yeah. And when you factor in that traders on these platforms can use up to 5x margin, I mean, they aren't merely betting on the final outcome in 2027, they are betting on the volatility along the way.
Okay, let's unpack this for a second, because if you were listening to this, you might be wondering, wait, is it even legal to use borrowed money to bet on a foreign election?
That's the million-dollar question.
Right, but in the decentralized world of crypto-backed prediction markets, it is happening. And at a massive scale.
Oh, massive. Millions in volume.
And to really grasp the sheer stress of the bets these traders are making, we have to first understand the rules of the game itself. The French electoral system is practically built in a laboratory to create financial volatility.
It really is. I mean, the entire engine of this market comes down to the French two-round system.
I look at this like a sudden death sports playoff bracket. The French presidential system isn't a winner-take-all single election like you might see in the U.S. or the U.K.
No, not at all.
In the first round, you have this massive, crowded field of candidates. Like everyone jumps in the pool. But here's the kicker. Only the top 2 candidates advance to the second round.
Right. The top 2 survive. Everyone else is out.
So you have this massive scramble, and then suddenly, overnight, half the field instantly vanishes.
In financial terms, we call that a binary volatility compression point.
That sounds intense. What does that actually mean for a trader?
Well, consider the candidate who is polling at, say, 15%. In a parliamentary system, 15% means they have a solid base. Maybe they get some seats, they form a coalition, they have influence.
Right, they get a seat at the table.
Exactly. But in the French presidential system, that 15% is balancing on a knife's edge. They either squeeze into that top 2 and make the runoff, or they go to absolute zero.
Wow.
Yeah, there is no prize for third place here. The market contract literally resolves to $0.
And that structural reality completely changes the math of leverage, right? The source analysis breaks this down brilliantly. Polymarket contracts move in probability points.
Right, from 0 to 100.
So let's say you buy a contract on a candidate at a 20% probability and their odds go up to 30%. That's a 10-point move.
Which is a huge jump in this market.
Yeah. And without margin, capturing a 10-point move on a 20% position generates a 50% return on your money.
Which is a fantastic return for passive capital. I mean, any traditional stock investor would be thrilled with a 50% gain in a year, let alone a few weeks.
Oh, absolutely. But this is where the 5x leverage comes in and just pours gasoline on the fire.
Right, because now you are borrowing.
Exactly. With 5x leverage, you are borrowing money to multiply your exposure. So that exact same 10-point move from 20% to 30% doesn't just give you a 50% return. It becomes a massive 250% return.
It's exponential.
You are effectively supercharging small shifts in probability into massive financial gains. But wait, I have to push back here for a second.
Go for it.
When you introduce 5x leverage into something as notoriously chaotic as a political election, I mean, is this really any different from just walking into a casino and putting it all on red? Where is the actual analytical edge?
That is the core question every trader has to answer before risking a single dollar. The edge doesn't come from guessing voter feelings.
Okay, so where does it come from?
The edge comes from understanding the divergence between legal reality and political reality.
Legal versus political.
Yeah. Traditional polling asks voters who they like today. The prediction market asks traders what is legally and practically going to happen tomorrow.
Ah.
And that brings us to the biggest, most explosive divergence in the entire market right now.
The legal drama that is currently tearing the market's probabilities apart. We're talking about Marine Le Pen and the National Rally.
Exactly. Because if you were just reading the traditional French surveys, you would think Marine Le Pen was sitting in an incredibly strong position.
Right. The polls love her right now.
They do. The voters are pricing her as highly competitive. But if you look at the trading data on Polymarket, her odds have absolutely collapsed.
It's a bloodbath.
It really is. She has dropped from 35% down to 19%. That is a 16-point drop, which the analysis notes is the largest single candidate repricing we've seen in this entire election cycle.
And the catalyst for that 16-point cratering has absolutely nothing to do with her popularity, right?
Nothing at all.
It is entirely legal. It goes back to her embezzlement conviction appeal trial that wrapped up back in February 2026. The Paris Appeals Court has set the final verdict for July 7, 2026.
That's the gavel drop we mentioned earlier.
Right. And right now, she has a 5-year status ban hanging over her head. And the detail that really struck me in the source material is her ultimatum. She explicitly stated she will not run for president if she is sentenced to wear an electronic monitoring bracelet.
Yeah, think about the mechanics of that for a trader.
It changes everything.
It does. Anyone who is holding a long, highly leveraged position on Le Pen through that February appeal trial got completely wiped out. The market is currently pricing her odds of actually winning the appeal at only 20 to 24%.
So they basically think she's done.
Pretty much. Polymarket traders are heavily discounting her viability. They are making a strict legal judgment that the court will uphold her ban on July 7, regardless of what her polling numbers say.
Which creates this massive multi-million-dollar vacuum. I mean, if Le Pen is legally barred from running, who steps into that space?
Enter Jordan Bardella.
Right. He is the leader of the National Rally, and he is now leading the entire Polymarket field at 26%. And that number is climbing fast.
The underlying polling data for Bardella is staggering, honestly.
What are the numbers?
Well, the May 2026 IFOP fiducial data shows him polling at 34 to 36%. In any normal race, those numbers would make him the heavy favorite to win the first round outright.
Wow.
Furthermore, head-to-head polling from Connection France shows him beating the leading centrist, Edouard Philippe, 53 to 47.
So let's look at the gap there. The market sees Bardella at 26%, but the polls say he should be at 35%.
Right.
That 9-point gap is pure, distilled uncertainty about whether Le Pen is actually forced out. If the ban is upheld, traders are betting. Bardella just inherits everything, her political apparatus, her base, her momentum.
Everything.
And a 5x leverage long bet on Bardella, moving from his current 26% to that 35% polling average, would yield a 170% return.
It's an incredible trade if you get it right.
But here's where it gets really interesting. Can political capital really be transferred one-to-one like that?
It's a fair question.
I mean, it feels a bit like a corporate succession plan where a legendary founder steps down. Think of Apple after Steve Jobs, right?
Yeah.
Can a new leader just instantly absorb that decades-deep brand loyalty? Bardella simply lacks her years of brand building.
It's a critical point to challenge, and you're right that political capital isn't just, a bank account you can hand over to the next person in line.
Right, you can't just write a check for voter loyalty.
Yeah. Exactly. A corporate succession analogy is apt, but we have to look at the specific corporate culture of this party. The historical data and market sentiment suggests that National Rally voters are exceptionally cohesive.
They stick together.
They do. They are an institution built on loyalty. They have consistently shown that they will follow the party's standard bearer. So while Bardella might not have her decades of personal brand equity, the traders are looking at the historical floor of that party's base.
So the floor is incredibly solid.
Very solid. The momentum short on Le Pen and long on Bardella is currently viewed by the market as the highest probability trade because that voter base rarely fractures.
All right, I see the logic there.
Yeah.
But, I mean, if I'm a trader holding a 5x leveraged bet that relies entirely on what one Parisian judge decides before breakfast on July 7, my stomach is probably in knots.
Oh, it's an incredibly volatile position. You'd be sweating every day.
Right, so if the far-right trade is that explosive, where do traders park their money for stability? Or, conversely, where do they look for crazy long-shot asymmetry? Let's pivot logically to the rest of this massive 18-candidate field.
Yeah, so when traders need stability, when they want to hedge against the chaos of the extremes, they look to the center-right. This is where we find what the report calls the portfolio anchor.
And that is Edouard Philippe, right? Currently sitting at 20%.
Yes. He's the former prime minister, and according to the Ipsos polling in the source, he actually commands the highest approval rating of anyone in the field at 36%.
So he's well-liked.
Very. The analysis frames him as the ultimate safe haven asset. You hold Philippe at 20% because if Le Pen is banned and if Bardella somehow stumbles under the massive pressure of the national stage,
Which could absolutely happen.
right, then Philippe becomes the default structural establishment choice to unite all the anti-national rally voters in the second round.
So he isn't the explosive leverage play that Bardella is, but he is the structural bedrock of a balanced political portfolio.
Exactly. He's the blue chip stock. But traders also like to have contingency plans.
Yes.
If they want higher variance within that center lane, they look to Gabriel Attal. He is sitting at 9%. He was the youngest prime minister in French history at just 34 years old.
But Attal currently trails Philippe 9% to 14% in the May 2026 IFOP polling, when they are both included in the race.
Right. He's definitely second in that lane.
So Attal is effectively the backup plan. If Philippe stumbles or fails to gain momentum, Attal is the natural beneficiary to scoop up those centrist probability points.
And then we look across the aisle to the left, which is currently defined by one-word fragmentation.
Oh, it's a mess over there.
It really is. You have Jean-Luc Melenchon at 13%. He launched his fourth presidential run in May 2026 with a major rally in Saint-Denis. And we have to remember, in 2022, he missed the runoff by just 1.2 points behind Le Pen.
He was incredibly close to making that final binary bracket.
Very close.
But his path this time requires absolute unity on the left, and the market clearly doesn't buy it. I mean, there is a united left primary scheduled for October 11, but Polymarket is currently pricing a 56% chance that the primary just gets canceled outright.
A 56% chance of cancellation is a massive, blinking red signal of internal fragmentation.
Yeah, it means they can't even agree on how to hold a vote, let alone who should actually win it.
Which naturally brings us to the deep value section of the market, the extreme long shot.
Because pink stocks.
Basically, yeah. You have Bruno Retailleau for less Republicans at 6%, running as a strict hardliner on order and immigration. You have Raphael Glucksmann at 5%, courting the center-left and explicitly rejecting Mélenchon's approach.
You just had a big rally, right?
He did. He just launched his campaign in Aubervilliers on June 13 to a crowd of about 3,000 to 4,000 people. And then you have Karim Beaumorin, the socialist mayor of Saint-Ouen, sitting all the way down at 2%.
Okay, let me stop you there, because this brings up a huge question for me. With 18 confirmed candidates, and the big players like Bardella and Philippe gobbling up all the oxygen and the probability points, why would any rational trader risk real capital on a 2% long shot like Beaumorin or a 5% candidate like Glucksmann?
It seems crazy, right?
It does. I don't buy the idea that they're just throwing money into a wishing well.
Well, if we connect this to the bigger picture, it all comes back to a concept called an asymmetric bet.
Okay, explain that.
In traditional investing, a 2% chance is basically a rounding error. You ignore it. But in a leveraged prediction market, an asymmetric bet means your potential downside is strictly capped. You can only lose the small amount of capital you put in. But your potential upside is exponential.
Oh, it's like angel investing in venture capital.
Yeah.
You fund 10 startups knowing 9 will probably go bankrupt. But the one that becomes the next Uber pays for the other 9 and then some.
Exactly the right framework. Let's look at the math on Glucksmann at 5%. If that internal fragmentation on the left reaches a boiling point, and the party suddenly realizes Melenchon can't win, they might unexpectedly unite behind Glucksmann.
And if they do?
In that scenario, his probability could easily jump from 5% to 20% almost overnight.
Okay, doing the mental math on that. A jump from 5 to 20 is a 300% return unleveraged.
Now apply the 5x margin.
Oh, wow.
Yeah, that 300% unleveraged move becomes an effective 15x return on your money. That is why traders put small amounts of capital on these long shots. You only need one Glucksmann to hit that momentum spike to make the whole portfolio highly profitable.
That makes the math incredibly clear. So we've mapped out the major players, we know the odds, we understand the mechanics of asymmetric bets. But the final piece of the puzzle for these traders isn't just what is going to happen, it's exactly when the market will realize it and reprice.
Because political markets are not fluid. They don't move in a smooth, continuous line like a slow-moving demographic shift.
Right, they aren't gradual.
No, they jump violently at specific, discrete catalysts. And if you wait until after the catalyst happens to enter your trade, you are paying retail prices. What we call the volatility premium is already gone.
So what does this all mean? I look at this calendar of catalysts almost exactly like corporate earnings season for the stock market.
That's a great way to think about it.
Right. If a major tech company is about to announce a revolutionary new product, you don't buy the stock the day after the announcement when the price is already spiked. The opportunity is gone.
Too late.
You position yourself weeks beforehand. You take on the risk of uncertainty to capture the premium.
And this election has a very rigid, unforgiving earnings calendar. It starts in late June and early July. You have Edouard Philippe holding major campaign rallies on June 25 in Reims, and another on July 5.
And traders are watching these closely.
Oh, very closely. Traders use these as momentum checks. If he has a huge showing, it cements his 20% anchor position. If he looks weak, the door swings wide open for Attal to steal his probability points.
And then, literally 3 days later, we hit the absolute epicenter of the market, July 7, the market-defining catalyst.
The verdict.
Yes, the Paris Appeals Court verdict for Marine Le Pen. The source analysis makes this incredibly clear. This single ruling will force every single contract in the entire market to reprice simultaneously.
Because if she is officially banned, the dominoes fall instantly.
How so?
Well, Bardella immediately consolidates the right-wing probability points. Philippe's role as the centrist savior is cemented, and the left realizes they are facing a united right-wing front, forcing them to react. Everything changes in a split second.
And what's wild to me is that the consensus trade right now, like the position almost everyone is taking, is going long on Bardella and shorting Le Pen.
This raises an important question about market psychology, actually. When a trade becomes that crowded, what happens if there is a surprise?
Oh, like if she wins the appeal.
Exactly. If the appeals court unexpectedly rules in Le Pen's favor on July 7, the violent unwinding of that crowded consensus trade will create massive, chaotic market swings.
Just total panic.
Complete panic. Bardella's contracts would crash, Le Pen's would skyrocket, and anyone who is over-leveraged on the wrong side of that bet gets completely wiped out by margin calls.
It's a literal financial powder keg. And once we get past the smoke of July 7, the calendar just keeps marching. We have the scheduled United Left primary on October 11th, again, if it doesn't get canceled.
Right, big if.
And then around February 2027, the underlying mechanics of the French system take over again with the 500 signatures collection period.
Ah, the parenages. This is the 10th Friday before the first round, and it acts as a crucial mechanical filter.
How does that work?
Candidates have to prove they have the official backing of 500 elected officials just to get their name printed on the ballot. This effectively freezes the field.
Oh, so it weeds out the fringe players.
Precisely. The 2% and 5% long shots who can't convince mayors to publicly put their names on the line are instantly eliminated. Their probability points don't just disappear, though. They get concentrated into the surviving candidates.
Which all leads to the ultimate binary events. April 10th, 2027, the first round of voting. Pure survival of the fittest. You either make the top two or your contract goes to zero.
No middle ground.
None. And then April 24th, 2027, the second round. The absolute resolution. One contract hits 100% and the other goes to zero. It is breathtaking how structured this chaos actually is when you lay it out on a timeline.
It really highlights how prediction markets force discipline on the observer. You can't just operate on political vibes, party loyalty, or what you hope will happen.
Right, vibes don't pay out.
They don't.
Okay.
You have to understand the legal mechanics, the electoral calendar, and the exact mathematical thresholds required to survive at each step.
And that brings us to the ultimate takeaway for you, the listener. Being well-informed in today's world isn't just about reading the traditional polls or watching the Sunday morning political talk shows.
No, it's way deeper than that now.
It is increasingly about watching where the smartest, most leveraged money is moving in these prediction markets. The traditional polls are telling us who the French public likes today. But the prediction market, driven by traders risking huge amounts of capital on 5x margin, is aggressively pricing in the cold, hard, legal reality of that July 7 court date.
They are telling us a story about the mechanics of power that the polls simply cannot capture. They strip away the emotion. They don't care about the speeches. They care about the catalysts and the probability of survival.
But it does leave me with one final, very provocative thought to mull over.
Oh, what's that?
As these political prediction markets grow, as they become these massive entities holding hundreds of millions of dollars with highly leveraged bets, what happens when they stop merely predicting the news and actually start influencing political reality?
That brings up a fascinating financial theory called reflexivity.
Reflexivity.
Yeah, coined by George Soros. Reflexivity is the idea that investors don't just base their decisions on reality, but their decisions actually change the reality they are observing.
Wait, so if a candidate's odds suddenly crash on Polymarket because of, say, a rumor or a bad debate, does that visible public crash in their quote-unquote stock price trigger a real-world loss of campaign funding?
It very well could.
Does it cause their volunteers to stay home because they look at the market and think the race is over? Does the prediction market effectively become a self-fulfilling prophecy where the traders aren't just betting on the outcome, they are actively creating it?
It's a profound shift. We are moving from a world where markets observe democracy to a world where markets might actively participate in the psychological momentum of democracy.
It changes everything about how we consume political news. Well, thank you so much for joining us on this deep dive. We've covered the asymmetric math, the leverage, and the incredible legal drama shaping the future of France. Keep your eyes on that gavel on July 7, and until next time, keep questioning where the numbers are really coming from.